Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me is Sonal Bhutra, and things are getting a bit painful for our markets now, extending itself on the way down. The Nifty and the Sensex lower by 1%. The Nifty closer to 25,950. The Sensex, after losing 800 points, is now down to levels of 84,750. Realty, auto, banks, all of them are struggling. It's only the metal index which has hit a record high given what's happening with China. And in fact, China continues to steal the spotlight even today. The Shanghai index is up 5.5%. Hang Seng has moved up 3.5%. Nikkei continues to struggle. And in just this month, China has literally made up all its underperformance. Month to date, in the month of September, the Shanghai index is up close to about 15%.
That's a big move that we are seeing. It's a lot about the Asian markets now, right? We're talking about those big moves in the Hang Seng. China, of course, remains the top story to talk about as well. But just for our own markets, if you look at the Nifty, a lot of these heavyweights are putting pressure right now. Mid caps, I would say they are actually outperforming the markets, considering the fall is not as much as the benchmarks. Reliance is the one that I wanted to point out. That's putting a big pressure on Nifty today. And this is followed by ICICI Bank and HDFC Bank. So these three putting pressure of around 110 points on the Nifty right now. So we'll keep tracking that for you. But we do have a big voice on the show today. We'll be chatting with Mark Mobius, the chairman of Mobius Emerging Opportunities Fund, joining in now to discuss his view on emerging markets, what happens to global markets after the Fed rate cut, and a lot more. He's joining in now to have that conversation with us. Mark, good morning. Thank you so much for joining in today. And, you know, we are talking after a long time, especially after so much has happened in the global markets. We're talking about the Fed rate cut, a lot of stimulus that has come by in the Chinese economy as well. So first up on China, do you think this is the time to look at China and China could outperform Indian markets?
As you can see, in the last few days, China has outperformed the Indian market. But I think this is going to be temporary. There'll be a pullback. Nevertheless, it's a very, very positive situation, not only for China, but for all emerging markets. Why? Because, as you know, China represents such a big part of the index, of the emerging markets index. So you've seen China is now up tremendously, and that drags the emerging markets index as well, because India is such a big part of the index. Now, what happens? That helps all emerging markets, including India, because 50% of the money going into emerging markets is index money. So when the index goes up, a lot of people pile in, which is why you're going to see more and more investors coming to India as well as China.
Mark, good morning. That point is well made. The China outperformance helps all emerging markets in terms of the fund inflows into emerging markets. But what about China per se? You're saying that this up move perhaps is a bit tactical. You're still skeptical whether there are more legs to go. Why is that?
Simply because it has to be made clear to entrepreneurs, the big entrepreneurs in China, that the government is behind them and will not interfere with their businesses. As you know, under Xi Jinping up to now, the big entrepreneurs have really been under pressure, and many of them have been leaving, or at least not participating in the market. Now, Xi has been saying he wants to help entrepreneurs, particularly small entrepreneurs. That's a very, very good sign. Politically, it's a sign that the situation is changing. He's beginning to change his stance, and that would be positive for the market. So I think maybe what we've seen now is maybe a little bit too much on the upside. There'll be a correction, but I think we're now probably in a new bull market for China.
So do we need more on both fronts, fiscal and monetary stimulus in China now, Mark, to look at a more defined rally in the Chinese markets?
Yes, I think you're going to see more activity in China. As I said, there'll be corrections along the way, but I think we're now starting a new bull market.
That's interesting. A new bull market emerging in China. Investors have burned their fingers over the last couple of years with the kind of underperformance. So now India versus China. India's already in a bull market. All signs appear that India's bull market continues, and now you've got China with one too. So how would you compare the two?
Well, what's going to happen, of course, China is larger than the Indian market, but India is now catching up. As you know, they're beginning to change the indices to favor India more and more, a heavier weighting for India. And that means that, as I said, 50% or more of all money going into these emerging markets is index money. So when India takes a bigger share of the index, more and more money comes into India. So I think the fact that China is on the bull market is very positive for India and all other emerging markets.
Okay, so one is the Chinese factor that you're talking about, which will work for emerging markets. What are the other triggers for Indian markets now, Mark? Because we are already seeing valuations at highs across most of the sectors. What would the next trigger be for Indian markets? Even earnings, they were very tepid in Q1. The expectation is 15 to 18% for FY25 for Nifty. What is making you positive on the Indian markets?
What's positive is a long-term picture. There's no question that India is on a growth trajectory and is doing very well economically. Now, the problem facing India, as SEBI has pointed out recently, is derivatives have become too big. There are too many people gambling on derivatives, and that could put a damper on the market. So we have to watch what measures SEBI is going to take in terms of the derivatives. When that happens, you'll probably see a downturn in the market, just temporary downturn, but you'll see some correction in India. Nevertheless, we are now on a long-term bull market for India, and I see Sensex, the Sensex index going up to 100,000.
How soon? Sensex at 100,000?
Yes.
How soon would that happen? By when do you expect that mark of 100,000 on the Sensex?
Probably by the end of the year, provided that the measures taken by SEBI do not put a big damper on the market. That's something that we have to watch.
But in your assessment, even if we do have measures, adverse measures, it will cause only a temporary downturn, right? It's not something which can puncture this long-term bull market in India.
That's right. The bull market is there and will continue because India is on a growth trajectory which cannot be stopped.
Sure.
We're in a tremendous period of India's history that has not been seen before.
Any fresh ideas in terms of individual stocks, Mark, when it comes to India and your investments?
I can't give you individual stocks, but I would say the sectors that are probably most interesting now is real estate. The demand for housing in India will continue to soar, and you're going to see more and more demand for middle and lower income people to have good housing. That's a very important sector. The other is metals and automobiles. Again, infrastructure spending is on the upbeat. More and more infrastructure you will see. And so therefore, metals is a good area. The other area would be infrastructure related to metals. As you see, infrastructure is going like great guns. And of course, the need for more and more infrastructure in India is tremendous. And then don't forget pharmaceuticals. I would say India being the largest exporter of pharmaceuticals will continue to be doing very, very well.
Okay, so those are some sectors that you like. The other space would be the emerging themes, right, Mark? We've been a service economy for a long time, but now we are focusing on products as well. Semiconductor is a big theme. Do you like something in that space, the allied sectors that could benefit from that and the opportunities there?
Well, I'm very bullish on semiconductors in India, but this takes time to develop. India, of course, as you know, is a big exporter of software. But eventually it'll become a big exporter of hardware, computer hardware, which includes chips, semiconductors. But that takes time to build. And hopefully the measures taken by government to free up the import market will be very important because in order to produce this hardware, you need to import components, equipment, etc. That means you've got to free up the import market. That is beginning to take place. Modi is beginning to loosen up on these controls, and that means you can build a very, very vibrant semiconductor market.
Mark, if we may request you to just hold that thought, we need to slip into a very short break, but we want to continue our conversation on the other side. So do stay tuned in.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Let's continue our conversation with Mark Mobius. He's the chairman of Mobius Emerging Opportunities Fund. Mark, we spoke about the sectors that you like in India and what's happening with Chinese markets as well. The big event of that Fed rate cut and possibility of more in this calendar year itself. Do you think apart from emerging markets, there are other markets which are looking interesting to you that tend to benefit from the developing space?
Yeah, there are other markets, but it's very, very selective. As you know, the U.S. market is doing very well. And one of the reasons why there's so many interesting companies in the U.S. is because they are benefiting from the surge of emerging markets development and growth. So I would say selectively you could look at the U.S. market, but the emphasis should be on those companies that have exposure to India, to China, and to other emerging markets, either in terms of supplying these markets or buying from those markets. So it's really a mixed picture for the U.S. market, but you can't ignore the U.S. market. It's so huge. And there's so many things going there.
So, Mark, if you had $100 of a fresh investment to make, how would you divide it in terms of the US markets, in emerging markets, and within emerging markets, since China is now playing catch up, would you look to realign the weightages? So break up that $100 for us in terms of a fresh investment today.
Well, I would say at least 50% in India, then 25% in China and Taiwan. By the way, whether you consider Taiwan part of India or not, it is very much benefiting from the surge in growth in China. So you have to include Taiwan. And then another 25% divided between Vietnam, Turkey, Brazil, and then Korea and Thailand. Those would be the breakdowns. Again, notice I haven't put anything into the US because I believe now's the time for you to be in emerging markets rather than the US market.
Okay. What we've seen earlier, and there was a Citi note that I was reading, it said that FIIs have historically been sellers of Indian equities in the month after a US rate cut cycle begins. What is the FII view now, Mark, according to you? We did see that big flow coming in September in terms of FII flows, and that has not been very consistent now in Indian markets. Do you think we'll continue to see these flows? How are FIIs viewing India now?
You're going to see more FIIs coming into India. As you know, many of the FIIs have been going into derivatives. So you're going to have a lot of very short-term money in India for that purpose. But generally speaking, because of the index, as I mentioned, the heavier weighting of India in the index and the fact that the index is going up on the back of China moving up will be very positive for India. And you'll see more flows into India from the foreign investors.
How concerned should we be about the valuations? Because Indian markets, despite very high valuations, have continued to outperform and soar. So is there really a big consideration now for Indian markets when it comes to fresh investments, high valuations?
Well, many people measure valuation on the basis of PE, price earnings ratio. And yes, of course, if you look at the price earnings ratio, it's very high by historical terms. However, what people forget is the E of the P. You have the price and the E, there's earnings. With earnings moving up at such a fast pace, the market looks not overvalued because of that big move. So you have to look forward. A lot of people, of course, look back. They say, oh, the PE looks high, but they forget that the market is moving at such a pace and the growth in the country is so great that the future PEs are actually coming down.
Okay, but it's just that for this year and the way we have seen Q1 performance, E also isn't looking as exciting as it used to earlier, right? So there has been a concern around future earnings growth in some of the sectors which have seen returns which were not expected earlier anyway, Mark. But the other asset class which has been doing really well is gold. Is it still the time to look at this particular commodity? How much can one put into gold at these levels?
I think it's a very good idea to hold gold, maybe 10% of your portfolio. I think gold is very important to have. And as you know, one of the reasons why gold prices are moving up is because of Indian buying. With per capita income moving up in India, of course, there's going to be more money going into gold because Indians, you know, traditionally love gold, like to have gold, and consider gold a currency.
Mark, getting back to India, you listed out many sectors which look interesting to you: real estate, affordable housing, infrastructure, etc. You skipped out banks, and banks is the largest chunk of where the FI money is parked in India. So, you know, one argument which has been made for a very long time now is that Indian markets are at an all-time high valuations, but the relative valuation of banks is still attractive because banks are nowhere close to the historical high valuations it's enjoyed in the past. So why have you, not added banks in your list of sectors which you like in India?
Well, in that list, I would add financials. As you know, I've given you 3 sectors. I would add the 4th one would be financials. Yes, that's a good possibility. Generally speaking, I'm not excited about banks because it's very difficult, not very transparent. It's very difficult to know what kind of loans they have on their books and what could go bad. So you have to be cautious with banks. Look at if you can, look at the loan book. Very often that's not available. But yes, banks would be a sector to look at.
So you would like banks as a space as well, apart from real estate and pharma that you spoke about. Mark, I was looking at the fund holdings, and Persistent Systems is one of them that you have in your fund, that is the Emerging Markets Fund. How do you look at the entire IT space? And in the IT space, do you like the large caps or the mid caps right now?
Well, as you know, I love technology. I like to be in technology, whether it's be software or hardware. But as I mentioned, the sectors that I quoted previously tend to be faster moving at this stage of the game. And I think that's where you want to be. Doesn't mean Persistent is not a good stock to hold, and we will continue to hold. But generally speaking, we're better off in the sectors I mentioned, the real estate, and that's the metals and infrastructure.
Mark, increasingly a lot of experts we speak to are sounding cautious now. They're saying that the run-up has just been too much, too soon, too excessive. In fact, one of the fund managers today said that it's time for fund managers to be risk managers. So while, yes, India's long-term bull market is structurally intact, just over the next 12 to 18 months, would you be a bit cautious given where we are? Outside of the SEBI action on derivatives, are there any risks lurking on the horizon?
Well, that is the key risk. As I mentioned, if you have SEBI coming out with regulations to limit exposure to derivatives, then you could have a downturn in the market because, as you know, there's a tremendous amount of derivative activity in the market, and that would have a big impact. So that's why, yes, I think the advice of fund managers to look at risk is very, very sound and very timely. It's a good time to consider that. And of course, as I mentioned, I've always said that despite the long-term bull market that you see in India, there will be corrections along the way. And a correction could be 5, 10, 15%. That's for part of the activity of markets generally around the world. So expect that, but be ready to buy in again when the market comes down, because there'll be opportunities to buy cheaper stocks.
Okay. So Mark, anything that you've bought into or you have your eye on waiting for the markets to fall? We had spoken earlier, you said you like Tips Industries, there's Netweb Technologies. Is there anything new that you are finding interesting in Indian markets, apart from the spaces or themes that you spoke about?
Well, I'm very interested in the whole semiconductor area, and I noticed there's been more and more activity in that sector. As you know, Modi has recently inaugurated, I think, 3 major investments in semiconductors, and there have been a company like Micron has come into India with $1 billion+ in investment. Those sectors are going to be very, very interesting, and we have to keep an eye on them.
Have you been investing in the primary markets? We've had an IPO boom in India, Mark. Some are saying perhaps it's not a boom, maybe it's heading towards a bubble. What have you made of the IPO action? And have you been participating?
Well, when you have such a bullish market, obviously it's a great opportunity for people to list their stocks because you can get a good price, a high price. In my view, it's not a good idea to pile into these IPOs unless you're very, very certain about their earnings growth. And as you know, many of these IPOs, their earnings growth is questionable at best. So I think you have to be very, very careful in a bull market to buy IPOs.
And would you say the same for new age companies? Would you buy into something like a Swiggy, Hyundai? Those are the two big names that we are watching out for now.
Not yet. I'd be wait. Usually, what I like to do is let an IPO go to the market, let it get some experience in the market in terms of the buying and selling that takes place after the IPO, and when things settle down, then that's the time to buy.
Okay. Mark, we spoke to you a lot about stock-specific ideas and sectors as well. What are you reading now, and what is your next destination for traveling? 112 counting in terms of countries visited. What's on your radar?
Well, India is on my radar. I'd like to get back to India. As you know, I took a month and a half last year in India, and I want to take a longer trip to really see all parts of the country. You know, it's an incredible country with so many states and so many different situations and cultures. We have to see more and more of India going forward.
You've got to promise us a studio visit when you come to India next, Mark. It's always a pleasure chatting with you. Thank you very much for your insights. That's Mark Mobius, investment guru, emerging market guru, market veteran. We'll slip into a very short break. We'll come back and talk about individual stocks in India. We'll put the spotlight on PB Fintech and Paytm and find out why they're buzzing in trade. Welcome back. Let's talk about PB Fintech. Now, PB Fintech has said it will be a minority investor in the company via which the healthcare foray will happen, and investment will be up to $100 million. That's the word from Chairman and Group CEO Yashish Dahiya. They added that they're looking to bridge the trust gap between hospitals and insurance companies. Listen into that conversation.
PB Fintech is looking to make an investment subject to board approval in a separate venture, which actually is not a PB Fintech subsidiary. PB Fintech would probably be a minority investor between 20 to 35% equity holding, right? And this venture, for lack of a better word, let's just call it XYZ. XYZ has its own life beyond that, and PB Fintech's liability is limited to that first investment. It does not have any compulsion to keep investing into the future, right? And all this is subject to board approval. The model is essentially an HMO model. And this entity is obviously finalizing with its other investors and other partners. They could be healthcare companies, they could be insurance companies, they could be development finance institutions, they could be private equity players. You know, there's a whole bunch of people that it will speak to. This hospital is going to be aligned to the insurance industry. We are not really thinking about what it does to the other hospitals. I do believe it will, if successful, set benchmarks for the others.
All right, that's the word coming in from PB Fintech. But let's move on. Paytm CEO Vijay Shekhar Sharma has said that he regrets not choosing the correct banker for the company's IPO. Remember, Paytm stock had tumbled 27% on its listing day on 18 November 2021, making it one of India's worst large IPO listings. Currently, the stock is down 69% from its offer price. Sharma added that Paytm did not attract VC investments in the initial 7 years since the inception of the company, and that he has been bootstrapped entrepreneur.
I have a regret now, not in the joining of entrepreneurship. I've been entrepreneur for long enough now. I have a regret of not choosing the correct bankers for IPO. If you choose the correct bankers, जैसे भगवान के मंदिर में जाने के लिए आपको सही पुजारी चाहिए होता है, शायद हमने वो नहीं चूज करे तो उसका choose a right banker, my friends. अभी तो छोटी-छोटी IPO भी इतनी बड़ी हो जाती है. In Iran age, it was driver making a crore. In Paytm's case, I know 20 people who made ₹1 billion, 100 crores.
Excellent.
20 people. And many of them cashed out more than 100 crores. I'm a bootstrap entrepreneur who had to do a lot of cash generation by the business. And in that rush, I learned only one thing for ladies and gentlemen in the room. There's nothing called P&L. This profitability, which is a P&L, which is an opinion. The real truth is cash. Everything else is a trash.
That's the advice coming in from Vijay Shekhar Sharma, the lessons that he's learned and the difference in being a private company and public, and how the company had to focus on cash and improving its profitability metrics once it got listed. We'll slip into a very short break. We'll come back and focus on market technicals. Soni Patnaik from JM Financial Services joins in on the other side.
Welcome back. Well, the pressure continues. 277 points lower on the Nifty. The mid caps two down 250, and the Bank Nifty is the one which is taking it to the chin. That is the one which is underperforming with cuts of almost 670 points right now. So good time to get a technical check on the market. Soni Patnaik from JM Financial Services is joining us now. Soni, good morning. Thank you so much for joining in. Well, markets are at the day's low. Do you see some recovery, or do you think we could see further pressure from here on?
Hi, good morning, Sonal and Rima. Thank you for having me on your show. A much needed correction in Nifty. We've seen it heading, coming lower towards 25,900. However, it is very much close to its support area of 25,800. So there could be another 50 points of pain on intraday basis, but then it can recover from those support points and again retest 26,050 to 26,100. This can be the sideways range, as this is a truncated week and Nifty may remain in this range not for long. Any break below 25,800 can cause another raise, another caution, and raise another alarm for a further correction up to 25,600 odd levels. So I think 25,800 should act as a strong support, and one can place the stop loss around those levels. What is important right now to watch out for is Bank Nifty, which is just at its support of 53,200 to 53,000 level. There could be a bounce back from Bank Nifty. It can head higher again towards 53,500 to 53,700. So I think that's the level to watch out for when it comes to indices.
Okay. What about individual stocks? What would your trading ideas be? And a particular mention on Reliance Industries and what's happening?
Certainly. So the first buy stock would be from the metal space, JSW Steel, which has seen a very fresh breakout today, backed with strong rollover volumes seen in October series. So one can buy in JSW Steel futures with a stop loss of 1015 and a target of 1060 to 1080 can be seen. The second buy pick would be from the cement space, Grasim, which has also seen a good option chain breakout today above 2,800. So one can buy Grasim futures around 2,835 at current levels, keep a stop loss of 2,800 and a target of 2,870. A further target of 2,900 can also be seen. If we talk about Reliance, we can see that the stock is holding on to a good support level, above its 3,000 odd level. So I think Reliance is just at the cusp of its support. Any bounce back can be seen from lower levels of 29.90 to 29.80. One can continue to hold longs. The stock can test 3,100 in October series.
Okay, all right. Thank you, Soni, for joining in today and getting us your technical picks. That's a technical check on the markets. Time for a short break now. We'll get you more on the markets on the other side. Stay tuned for that. Welcome back. You're still tuned into Trading Hour. While the benchmark indices, they are seeing a lot of pressure, a lot of moving parts in the broader markets that we should be talking about. Naveen Fluorine is the stock that I'm tracking today. A lot of analysts, they visited the vast facility, the CDMO facility of the company, and there were some takeaways, important ones from that one as well. Management expects strong growth in the CDMO on the back of the Fermion contract that the company has entered into, and company is targeting 40% of their CDMO revenues to come in from the late stage molecules by the end of FY25. They invested a lot in there, and now they are seeing some growth come by in that particular segment. It is one of the two suppliers for the intermediate product going into Bayer's darolutamide. That is where the Fermion contract is helping them. So the revenue potential from this intermediate is $25 million, and it could rise to $75 million by FY29. The company says they can actually benefit from 50% of revenues coming in from this huge contract in FY29. And the 540 crore specialty chemicals plant, it is expected to commission by October end. The fly in the ointment is the recovery that we are seeing in the specialty chemicals business. They were expecting it in the second half, but there is no clarity on that. They are still talking about some demand visibility which is remaining clouded. Because of which Jefferies is an underperform with a target price of 3,000. They say continuous channel destocking and Chinese aggression, they are posing some pressure on their intermediates portfolio. Morgan Stanley has an underweight as well. They say near-term earnings are not yet fully de-risked, so upgrades are still some time away. It's all about the specialty chemicals business, which is making a lot of these brokerages nervous. Nirmal Bang, on the other hand, says they have upgraded the stock to a buy. The target price has been raised to 4,000, but that is on a rollover. They say, yes, while Chinese aggression and demand is still a problem, they see margin improvement from here on, and that is why they're bullish on the stock. But overall, the street is still divided on whether this chemicals recovery would come by or not.
Okay, thank you very much for that. Let's talk about the two-wheeler industry that's also in focus on the back of fresh brokerage notes. Vinny is here with the details. Vinny.
Good afternoon. So yes, talking about the two-wheeler space, we have UBS that has come out with a note, and they do like TVS Motors, Eicher Motors, while they maintain their sell on something like a Hero Motor and Bajaj Auto. Now, what they're highlighting specifically in terms of trends for two-wheelers, they believe that the discounting that one is seeing for two-wheelers, that started seeing a further increase. Now, in passenger vehicles, we're already seeing that increase. Two-wheelers, that is also a trend that seems to be continuing, and festive season, they expect this trend to continue. So yes, e-commerce platforms especially are indicating a very high discount. There's a sharp discount on these platforms, and that is because of increased competition as well as in terms of inventory pressures. They expect this discount through the season of festive season that will be starting just around this week, next week, to continue till the end of the year because of the festive season. So yes, discounting for Hero Motor, that's in the range of 11 to 18%. Bajaj Auto is on the higher end as well, 12 to 16%. So high discounts are being given by two-wheeler makers to actually attract customers. And while in terms of electric two-wheeler vehicles, the pricing is still below the ICE motorcycles or scooters. So that is why TVS Motors is gaining share, while we are seeing a bit of a loss coming in terms of market share from Hero MotoCorp, and that is why they're maintaining a sell on Hero and Bajaj Auto, while TVS and Eicher continues to be their buy pick.
Okay, so the two-wheeler industry continues to be in focus. We have the auto sales numbers, which are expected tomorrow as well. Thank you, Winnie, for joining us with all those important details. Let's slip into a break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Welcome back. It's below 25,900 on the Nifty, but names like Dr. Reddy's are trying to stage a bit of a recovery. Dr. Reddy's is up close to about 0.3%. Even the cuts on the PSC index, the Nifty PSC index, are getting trimmed to some extent. So ONGC is up close to about 0.7%. That's recovered nearly 2% off from the day's low. But it's time now to talk commodities. Manisha is here to tell us more about crude oil prices. Manisha.
Well, like all industrial commodities, we're looking at the crude oil prices as well, coming back a bit after 3% decline in the previous week. Well, there are 2 or 3 reasons why you have seen support come back in case of crude oil prices. One is that Israel really seems to be stepping up attacks on Iran-backed forces. Second is that the China stimulus is anticipated to support prices and demand, not immediately, but at least in the final quarter of this calendar year, we might see the impact of these stimulus start to show. That has been supportive as well. Third is the Hurricane Helen, which has forced 25% of output from Gulf of Mexico yet to be stalled again. That is adding premium to prices as well. And then the markets do believe that in the month of November, when the US Fed sits for another monetary policy, there is a 57% chance of a 50 basis point rate cut and 43% chance of a 25 basis point rate cut. So it really is a divided house, and 50% really seems to be aiding higher. The markets also keep an eye on Saudi Arabia, which is going to increase production by the end of this year. Remember, OPEC is also increasing production by 180,000 barrels per day from the month of December. So this increase in production, whether or not it coincides with better demand going forward, is something that's keeping the markets uncertain right now. And then it also has to do with the US presidential elections in the month of November. So there's a whole host of things that the final quarter of this year will bring about. In the meanwhile, for this week, it is going to be about the US Fed Chair Powell testimony in this week. You also have important data like inflation coming in from Eurozone, employment and retail sales from Japan as well. So there's going to be a lot of choppiness and reaction to these as well.
All right, Manisha, thank you so much for joining us with those important details on commodities. By the way, for the markets, Rima just mentioned Nifty is below the 25,900 mark. Bank Nifty is the one which is leading to that. HDFC Bank and Kotak Mahindra Bank. Watch out for these two. They are at the day's low, so some pressure coming in from these two big names, and that is something we'll be tracking very closely. HDFC Bank is at the day's low. It's down almost 1.5%, and Reliance Industries is the other one which is leading to a lot of pressure that we are seeing on the Nifty today. We'll keep tracking markets for you, but for now, it's a wrap on Trading Hour today. Stay tuned. Halftime Report is up next.